Hello, viewers. Welcome to part 6 of Fundamentals of Accounting. Now, in the previous session, we understood the components of expenses. So, we understood what are direct expenses are and what are indirect expenses, and what was that one criteria that you would apply depending on the nature of business, type of your industry, that criteria which will distinguish between a distinguish an expenditure between a direct expenditure or an indirect expenses, right? So with this we have covered about the components of balance sheet and the profit and loss account. Now let us quickly have a look at the summary of the component of balance sheet as a recall or as a recap, right? So here we are going to understand one more new subject, the standard of your debit and credit balance we will understand here. Okay, so we have seen about the balance sheet, and we also know what is the purpose of balance sheet and what information the balance sheet is going to produce. Okay, so balance sheet has got two sides, so we have to keep in mind that our accounting system is double entry system of accounting, right? So that means basically every report, we had discussed earlier that every report is going to have one side with a particular balance, and it is going to have another side with a particular balance, right? So now we understood the liability part of the balance sheet. Quickly, let us recap. So on the liability side, we understood the capital, we understood what are loans and loan liabilities, right? And we also understood about the current liability, and we also understood about the differentiation between each one of them, and how each one of these liabilities will be classified under this broad categories or under this broad group, right? And we also understood that this is where the order of liquidity in which the liabilities are represented. Similarly, on the asset side, we understood fixed assets, intangible assets, and what constitutes current assets. Again, if you see, the asset side is also here being listed in the order of liquidity, right? So now, very important aspect that we need to understand here. Like I mentioned, our double entry system of accounting should have two sides or two aspects to the account transaction. So one is a debit side, another one is a credit side. Now we have two financial statement, right? So obviously each financial statement, the accounts that are getting listed in balance sheet and the accounts that are getting listed in P&L account should carry a debit balance or a credit balance. But then how do we identify? See, we had discussed that in accounts there are only four group which we learned in our previous two session. That is basically all your accounts will roll up to these four primary group. The four primary groups are your liability, asset, expenditure, and income. Okay, so now how does each of the side of the financial statement gets represented with a default value, right? So we during our introduction, we discussed about the accounting standards. So there is a standard that is set, like for example, see, out of convention or out of the standard that has been set, so many things, I mean, like today we accept on the face of it. Like for example, so we say day, night. And again, interestingly, our entire life revolves around this two aspect of it. So most of our life is associated with these two aspects. Like, I mean, like day, night, male, female, good, bad, happy, sad. So I can keep on giving examples. So similarly, in accounts, we have the standard set that has to be a debit and there has to be a credit, right? So the like the father of accounting, Luca Pacioli, he had set the standard and he said, okay, so with various combinations, what he has tried, then finally he said, okay, now if you identify a particular account as a liability, and that liability should carry a credit balance. So if any account which has got a credit balance, it will be a liability, or I'll come to the next one. So one aspect is it could be a liability, or we will see what is that other or. Okay. Then, if any account is got a debit balance, then it has to be an asset. Okay. Or we will see in the next statement what is that other or. So obviously now you would have already understood or presumed that the liability, the credit balance will be liability or income. Debit balance has to be expenditure or asset, right? So that it's very clear because we have this only four primary account. And again, in my previous session, I had explained to you about the distinguishing factor. How do you consider a particular uh, money spent on a particular account, whether you need to classify as an asset or you need to classify as an expenditure? So I explained about that in the previous session. So people who have not seen my previous session, you I request you kindly visit. So there is a very long explanation given how to distinguish between an asset and an expenditure, right? So an asset or expenditure by default has to carry a debit balance. That's the standard. Okay. Similarly, liability and income will carry credit balance, right? So the other way, see, because people from non-accounting background, out of my experience of various sessions that I conduct for non-accounting people, so this area becomes little questionable thing. So hold on, have some patience, right? We will try and see whether we can complete in this session, or probably we'll have to break this into two sessions, because a lot of explanation is required for many of you from a non-accounting background to understand. And also, surprisingly, people from accounting background also, when we are now getting into the depth of the subject, for many of them, it will be like a deja vu situation, right? Oh, okay, I've studied long back, I completely forgot about it, right? So that's one nice thing, and it's a very interesting thing that we are going to see in this session, and maybe in the one or more upcoming session on the double entry system of accounting aspect of it, right? So the other way to identify what should be the default balance or a standard balance for these four groups. Asset, see, we know asset is something that we own, right? So if so debit balance, you say asset. So remember that anything if you are owning in the organization, then it has to have a debit balance. And then anything is an expenditure for you, because expenditure is something but where you get the benefit for a shorter period of time, otherwise it would be an asset. So it is just a split of the information that is there. So that is why expenditure also, as per standard, carries debit balance. So then, yeah, the next question that I mean, like, the next question that you will have in your mind is, how do I determine which one is an asset, which one is an expenditure? One example I gave you is fine, but then it becomes a little difficult. We will cover that. Okay. And liability is something which the company owes to somebody, right? So anything that company has to owe will carry a credit balance. Now the question will come, okay, why income for a company is a earning, right? So why income for a company is a liability? Very important thing that we need to understand here is that, why do I invest in my business, right? So the intent, so in the first class we saw the intent of starting a business is to, primary objective is to earn profit. That means when I'm investing money in some venture, I need to get a return on investment, right? So the owner invests money into the business, right? And the reward or the return for the investment is paid by the business by way of profit. That means literally. So again, we discussed how do you arrive at a profit. Okay, all my income, okay, minus my expenditure, the net of it. So if my income is more and expenditure is less, there is an excess of income. That is a profit. So to whom does it belong to, right? So it has to go to the uh, capital of the proprietor or partners, or it has to go to the shareholders. So that is why the other logic that you can apply for why an income carries a credit balance is that the net of the income after reducing the expenditure, if the excess of income, this is a liability. And that is why, if you notice, the profit of the business gets reported in the balance sheet. So that is one balancing figure. Income minus expenditure goes and sits into your balance sheet. And once this profit or loss and also your closing stock, which we discussed earlier, if these two values go into your balance sheet, then your liability will be equal to your asset. Okay, so again, we will see all this in detail in our upcoming sessions. Okay, so far is it clear? So the standard, it says that any account, if it has got a credit balance, it has to be a liability because company has to pay to that person, or it has to be an income because ultimately the net of my income minus expenditure is again a liability. Any account, if it has got a debit balance, then it has to be an asset or it has to be an expenditure. What if an asset can have a debit balance, is fine, but if an asset has got a credit balance, then what happens? Okay. I'll give you a very, again, a very simple example uh, for all of you to understand. So I start a business, I open a bank account, right? Now, my bank account is a current account. So all of us know what a current account is. And so which means literally I can keep depositing money, I can keep withdrawing money from a current account, right? As long as there is funds in my bank. The moment the fund in my bank becomes zero, I can't overdraw, right? I cannot withdraw, I cannot issue any check to anybody. Supposing if I had issued a check to somebody, and if the balance is lesser than the value of check that has been issued, the check gets returned. And we all know that nowadays, what is the implication of bouncing a check, right? So that's about the current account. So when I open a bank account, let us say I have 1 lakh rupee of money in my bank account. So that is my asset, it belongs to me. So the bank account, let us say you have a bank account in HDFC Bank. So the bank account in HDFC Bank is going to get reported in your current asset on the debit side. Now you apply for a OD facility, right? And the banker gives you, say, about 5 lakh rupees of overdraft facility, right? So you already have 1 lakh rupees in your account. Let us say now you're going to make a purchase, and you have to issue a check to the value of, say, 4 lakh rupees on that particular purchase to your vendor. So you issue a check of 4 lakh rupees. Your money is lying there only 1 lakh rupee. So now, since you have a overdrawing facility sanctioned for your business, when your vendor is going to present that check to my banker knows that you can, over and above your zero balance, you can overdraw up to 5 lakh rupees. So the value of check is 4 lakh rupees. So your fund of your business fund of 1 lakh rupee plus an additional overdraft of 3 lakh rupees is uh, issued, or the money is paid to the vendor. So now what balance does the your bank account, your HDFC bank account is going to show? So your HDFC bank account is now going to show 3 lakh credit, right? Is that your asset? Because you have to pay the 3 lakh rupees to the banker. Now, when do we pay? How do we pay? We will not discuss about that in detail. So I'm just trying to bring you the logic for you to understand how the balance of an account which has got a debit balance or a credit balance has an implication on your financial statement. And similarly, you will also have the implication in case of your profit and loss account. So now I cannot show this 3 lakh rupees liability as my current asset, right? So that is why, if you see on the liability side, on the loan liability, you will also have bank overdraft account. Generally, you report it there because it's not a short term loan. As long as your business is running, you keep continuing with that particular facility, right? So those are getting reported under your liability side on the loans. Okay. It basically, you have in case of Tally, if you see, we will see that we have a group called bank OD account, bank OCC account. So wherever we want, we can put that, but it is a liability. So so what do we understand from this simple example is that as long as an account is having debit balance, let's currently, I'm just talking about the balance sheet part only. As long as the any account is got a debit balance, then it has to be your asset. The example is money lying in your current asset is your asset. Okay. Now, the moment a particular ledger or a particular account, okay, has a credit balance, then it is no more an asset as far as the balance sheet financial statement is concerned. Okay, it's no more an asset. It has to be a liability, and that is what the explanation of the bank overdraft that we just now saw. Reiterates the point that it is a liability and it gets reported on the liability side, right? So please remember, going forward, this is going to be very important, and it's a very, very important fundamental or a bedrock foundation for all of us to understand the concepts of accounting. And believe me, if we can understand this, if we are thorough with this, okay, you will be a master of Tally, right? So it will not at all be difficult for you to handle Tally or work with Tally. You can work with Tally at ease, right? So these are very important fundamentals that we have to first understand before we jump into the product. Okay. So this is the component of balance sheet. So that is why your liability is represented by credit balance, asset is represented by debit balance. Okay. Then we have Then we have our P&L account, right? So P&L account, again, we saw expenses, right? So we discussed on the expenditure side, we said there are two accounts, direct and indirect. And I also mentioned in the previous class, generally, from a business point of view, if you see from anything, I mean, like generally as a trader or as a manufacturer, I would want to call out my purchase on top of my financial statement rather than putting it under my direct expenses, right? So that is why, though my purchase is part of my direct expenditure, we call that purchase as a separate group so that you can see them at the face of your P&L account statement. So we have purchase, direct expenses, and indirect expenses. Okay. Now on the income side, again, we call out sales because that is the value that's going to be a major information which any business would want to see at a click of a button on the face of the financial statement, which is the profit and loss account. So sales, I need to basically, we called out again. This is part of direct income. So sales you call out separately, and then you have direct income. So we understood what is direct income and what are the associated income that will form part of the direct income. And then uh, we understood indirect income and what constitutes indirect income. Again, we have to see how does this group gets represented in form of your double entry system, right? So as explained by me earlier, expenditure will have a debit balance. Okay. Income by default will carry a credit balance. Now I'll give you another example so that it becomes clearer for us to I mean, like, convince ourselves. I'm sure many of you are not convinced that why credit, why debit, right? So I hope that current account and OD account example gives you an idea about the representation of an account either as a debit or credit, as asset or liability. Similarly, let us take an example. Now here, in my organization, I create a ledger called freight charges. Okay. Now, whatever freight charges that I pay, okay, I go and enter it. So let us assume that I have just created one freight account. Okay. So let us say in my company, I have a new accountant and he is not a new person who I took him as a data entry operator. So he's just created one ledger called freight account and put it under indirect expenses. Right. So whatever is the freight that I pay, right? So generally what happens, let us say, as a sales promotional activities in my business, I would tell my customer that, okay, you place an order even if it is outside my area or outside my city or outside my state. Probably I will tell my customer that, okay, whatever is the transportation charges, we will bear. So which means basically the delivery will be given at your site, right? So what, I make a sale to my customer. Okay, there is my basic value, the taxes that I levy, and then there are transportation charges are there. Now I'm not going to charge the transportation charges with, say, few customers. Let's assume with few customers or my known customers or my customers who buy in bulk, I give them this benefit as a promotional activity. So I'm not going to charge the freight charges in my invoice, right? So I send the material, I hire my transporter, and maybe I would have an arrangement with him where per trip or once in a fortnight or once in a month, he will give me a consolidated bill for all the transportation services that he has rendered for me for various that expenditure, because I need to pay, because I'm not going to collect from my customer, right? So since I've created an indirect expenses, so whatever is the freight charges that I pay to my transporter, I am going to debit it because it is going to be my expenditure. Now again, don't worry, we will also see in our next session that when do you debit a ledger, when do you credit a ledger, and that is where a very interesting eye opener or learning we will have in our next session, right? So huh, so freight charges you are paying, so you are debiting. Pay money and towards freight charges, you debit that particular account. And for some customer, I told you, for some customer, you don't, I mean, like, deliver your goods uh, to their site, let's say. Okay, so you would say to these customers that, see, whatever is we will deliver to your site, right? But whatever is the transportation cost, right, so you have to pay us. Okay. Now there are two ways of charging this transportation charges. One is that when I'm invoicing to you, in the invoice itself I will add freight charges, and where when you are now going to make the payment to me, the basic cost of the material that you have purchased, the associated taxes, and also the freight charge that I have charged you, you will pay me. Now the freight charge that I'm charging you in the invoice, right? So I'm collecting that. So basically it is an income for me, right? So it's an income for me. So now let us assume, for us to understand this debit credit logic, I use the same ledger, like my data entry operator uses the same ledger, freight charges. Only one ledger is there. So he uses the freight charges ledger, and the credit also he starts capturing in the same ledger. So this is one way of charging credit charges to my customer. if I'm not charging, or if I don't know how much exactly is the cost of transportation, then what I would do, once the material gets delivered and once my transporter is giving me a bill, then I would raise a debit note on the customer and get the money refunded at a later point in time. Now, when I'm making a debit note, it is as equivalent to making a sale. So again, it is going to be a income for me. So again, I'm going to put that in my freight charges. So now if you see, my freight charges ledger has got debit transaction and it also has got credit transaction. So now I need to finalize my books of account. Year end has come. So now I add up this freight charges ledger. The total of my debit comes to say 25,000 rupees, which is I've borne from my from company's money. And the money that you have collected from your customers at the end of the year, you add up, it comes to 27,000. Now, debit 25, credit 27, excess is what? Credit is 2,000 excess, right? So now you created this freight charges as indirect expenses. So if it is indirect expenses, it has to be a debit balance. Okay. But this particular ledger has got 2,000 rupees credit balance after you net it off. Okay. So then it can't be an expenses, because I said all income should be credit. See, now you have spent only 25,000 rupees from your pocket as your freight charges, but you have collected 27,000 rupees. So there is a 2,000 rupees excess collection, which constitutes your income. So now that freight charges, if you are now extracting that freight charges because you are put under indirect expenditure, if you are extracting that ledger or that account in your expenditure, that part is going to show credit balance. So it is not your expenditure. The 2,000 rupees is an additional collection, which is your income, which needs to get represented on your income part as part of your direct income or as your indirect income, depending on the situation or depending on the nature of transportation expenditure that you make or recover, right? So this is again gives us a fair idea about how a particular balance of a ledger, irrespective of whether you put it under expenditure or income, asset or liability, if your closing balance of that particular account is credit, it has to be a liability or it has to be a income. If that particular ledger has got a debit balance, it has to be an asset or it has to be an expenditure, right? So I hope this again gives you more clarity on understanding the components of balance sheet. And the most important aspect in this session that we understood is about how this debit credit of our double entry system gets represented in the financial statement, and which type of primary group carries what type of balance, right? So we have understood all those things, and in our next session we will understand what do you mean by double entry system of accounting. And a very interesting topic that we will learn is the golden rule of accounting. So again, commerce students, you can now, this the moment these words will strike your mind, right? So we will see that in the next session. And until then, as usual, thank you very much all of you for staying till the end. And if you have not subscribed yet, I would request you to kindly subscribe, like it if you really like it, and also I would request you to share among your friends and colleagues so that they can also benefit out of this fundamental session. Thank you very much, and see you until the next session. Thank you.